Well, if you are thinking about getting in on the provincial government's matching loan program for first-time home buyers, there are some potential hazards you need to watch out for.
No doubt. Our consumer affairs reporter, Andrew, is here with that warning.
Yeah, there's plenty to consider here. Thank you, Chris. The province is now taking applications for those interest-free down payment loans the Premier announced last month. But financial experts warn consumers should read the fine print before signing onto the BC Home Partnership Program. Now, it's supposed to be a big break for first-time home buyers struggling to get into the market. The government will meet the down payment for up to 5% of the purchase price on homes worth up to $750,000 with a 25-year loan that's interest-free and payment-free for the first 5 years. The loan would be in the form of a second mortgage. Just keep in mind, registering it and removing it from your property's title would cost several $100s. If you got married or divorced and wanted to make any changes to the title, the loan would also become due immediately. And if you're putting less than 10% down, you'll pay an extra 0.25% on your CMHC mortgage insurance premium.
If you're using this program, you're technically borrowing funds to get to that 5% barrier. And the government is going to assess more risk to that and charge a higher premium of 3.85%, which quantifies itself as an extra $250 of premium for every $100,000 in mortgage you're going to acquire.
And here's an example of how negative equity could come into play. Consumers purchase a $500,000 home with 5% down, $12,500 from their own savings, and $12,500 from the interest-free loan. The first mortgage, including the 3.85% for your CMHC premium, would ring in at more than $493,000. Add in the second mortgage or interest-free loan, and your total mortgage debt is more than $505,000, leaving you with nearly $6,000 in negative equity, assuming the value of your home does not increase.
Negative equity is a scenario where the mortgage liability you're taking on exceeds the market value of your home. So if you're selling your home in a position of negative equity, you're essentially selling at a loss, which means you're losing money out of pocket.
And with no interest or payments for 5 years, mortgage experts also fear consumers will be in for payment shock when the honeymoon is over, especially if they were not proactive in paying down their second mortgage. And if you have a consumer issue for me, there's my email address at consumermatters@globalnews.ca.